this video, I'm going to talk about a very simple way of investing, but very powerful way at the same time. A lot of advisors will tell you to use a lot of complicated strategies with your money. You have to invest in 15 or 20 different funds as you make more money and make it extremely complicated. I mean, I see how that's beneficial for the advisor, but I don't see how that's beneficial for the client. Just because you make more money doesn't necessarily mean you need to have any more complicated strategies or any more complex strategies than you already have. If you have a solid 3-fund portfolio, you're pretty much set when it comes to the investing side. If you have that as your core part, and maybe you have a few other things on the side that you're also doing, maybe you want to do things like real estate or other types of investments. But if you have this core portfolio, you're in a pretty good spot for the future. And make sure that you watch until the end of this video, because I'm explaining exactly what that is and how you can get access to it and what funds give you access to it. Hi, my name is Pascal Manget and you're watching the Financial Ownership Podcast. So in this video, I'm going to be talking about a 3-fund portfolio. And the great thing is, it's a lot less expensive than you would see in an actively managed mutual fund, which they might charge 1.5% or 3% for you to have. And at the same time, there's a lot of times that these passively managed funds that I'm going to be showing you, they have more diversification than actively managed mutual funds. So the funny thing is, you'll get charged that high fee. You don't have any guarantees on your money, so if the market goes down, you're still gonna get charged at 1.5–2%. So if you're gonna be at risk and put your money at risk, it really doesn't make sense to be paying any type of actively managed fee or fee any more than, I'd probably say, 0.5%. If it's much more than that, you might want to reconsider and think about other ways to invest your money. Because in my opinion, paying 2% on your overall assets, to me, is kind of ridiculous. Considering that technology and all these type of things like apps that you could use your money and put your money in gives you access to those same exact funds or even better funds at a cheaper rate. Think about it like this. A lot of people, or you may be in the process of buying a home, or you might know someone in the process of getting a home. Typically, the realtor takes 6% of the commission when they basically sell the house, and that's what they get paid, right? So imagine, rather than taking that 6%, they got the person that's buying the house got charged 2% overall on the entire value for the life of the entire property. So let's say you have a 30-year plan where you have this house, or you had this house for 30 years, and your home value is $200,000. You're gonna be paying 2% on $200,000 for 30 years. Do you know how much that's gonna be in the future? That's gonna be hundreds of thousands of dollars, and depending on what value your home accumulates to, because typically homes go up in value, especially if you're talking about a 30-year period. You're going to be paying a lot in fees, considering if there was a way to take that route versus taking that upfront or having to pay the realtor that upfront commission. So if you think about it, if people do that, if people don't do that for the homes, they don't pay 2% of the overall value of the homes, why would they do that for their investment portfolios? It doesn't really make a lot of sense. Because if anything, if you're investing aggressively, there's a good chance that your investment portfolio could be more than the overall value of your entire home. So if anything, that makes it worse to pay an expense ratio on a mutual fund that's 2% when you could get a better performing fund with more diversification, paying basically nothing, or paying like 0.015% or extremely low expense ratios that typically happen with passively managed funds. So right now we're looking at Fidelity, and what I'm showing you right here is FXAIX. You could type in the ticker once you download the Fidelity app. It's pretty simple. You just put in your information, and basically you're gonna have access to a lot of different stocks and funds. So right now it's FXAIX, and it shows a large blend, basically consisting of the S&P 500 market. And if you look over here where my ticker is, it says an expense ratio of 0.015%. So relatively cheap, not very expensive, and you basically get exposure to the entire S&P 500, which is really great. And the good thing about this too is that there's no minimum amount that you have to invest. So if you look over here, it says $0. You don't have to put any. So a lot of index funds, they might require you to put like $3,000 or some large amount, but for this fund there's no minimum amount, so which is pretty cool. And as I scroll down over here, you can see this 1-year return is pretty ridiculous, 30%. You rarely see the S&P 500 perform like that, but after the pandemic the market recovered relatively strong. But if you want to look at the life of the fund, since this fund has been created, it's about a 10.96% rate of return. But this isn't meant to beat S&P or anything like that. This is just meant to mirror the S&P 500. So if you actually look at it over here, actually the S&P performed a little bit better, but this is meant to mirror to it to an extent and be relatively close to the performance of the S&P 500. So you can see it's very close to the overall performance of the S&P. And the next fund that we're going to look at is a bond fund. It's an ETF. And basically, it just mirrors different bond markets in the US. So you want to think about government bonds and high corporate securities, AAA securities. And you see the asset class is fixed income, ETF, and the expense ratio of this fund is 0.015%. A lot different from some of the other funds that you might see actively managed fund managers charging you, which is 1.5% or 2%, in my opinion, which is ridiculous. You don't need to pay that much for basically what you could get for your app, which most of the time is just going to outperform whatever they do anyways. And if you look down over here, if you look at the life of this fund, total growth or total return of about 7.05%. So really good for a bond if you think about it, if you ask me. And it gives you that diversification that you're looking for. And if you look over here, it says the investment seeks attractive performance of the Bloomberg Barclays US long-term government / credit float adjusted index. So it's not meant to beat any type of or be an extremely aggressive portfolio, but it's just basically going to be investing in some of the larger cap securities or the larger cap companies and high grade investment corporate securities. And basically it's going to be majority of US bond market. And lastly, if you want to have some international exposure, so exposure to maybe the Australian markets, the European markets, and the Japan market, and all these other types of markets outside of the US, FSPSX is the ticker. If you see over here, you could go in Fidelity and type that in there. And basically what this is, it's a low expense ratio international index fund. And if you look over here, it's 0.035%, extremely low. And all of these funds that I'm showing you, the cool thing about them is there's no minimum amount to invest. So you can start investing with any amount of money that you have, and you can continuously put money into this fund. And the cool thing, if you look over here, the return of this is pretty decent too. And if you look at this, it says for the life of this, it's been about 5.37%. Obviously, if you look at the last year return, things returned pretty strong after COVID, 25.11%. Not typical when it comes to these large funds or these index funds, because it's not meant to have these aggressive performances, but it's just supposed to give you decent rates of return over time. So if you look at this life part, that's probably more realistic to what you'll be looking at for the interest bearing power of this fund, which is about 5.37%. And if you look over here, at least 80% of the assets are invested in common stocks in basically Europe, Australia, and different types of foreign markets. And you could actually look at the total fund prospectus if you want to look more into it. But this is overall really solid fund. It gives you exposure to the international markets. You could do something like a 60% US market. I do think the US market should be majority of your portfolio, especially if you're growing it for a longer period of time. That might be different if you're a little bit older. But you could do something like 60% of the US market, 20% of the bond market, and 20% of the international market if you're someone that's in your 20s or 30s just looking to grow your portfolio over time. And you could basically have portfolio rebalancing to make sure that no one part of your portfolio gets more than the other, because a lot of times when you're investing in the long term, the stock part, it might overcome some of the bonds, and you might have a more risky portfolio over time. But things like reallocation or things like rebalancing when it comes to Fidelity, you can do that, which is pretty cool. So no part of your portfolio gets more than the other, so it automatically liquidate. This would be optimal if you have, let's say, a Roth account, so you're not subject to taxes. But if you're just using a plain brokerage account, I'd probably just leave it alone to make sure you don't pay any capital gains tax or anything like that you don't have to pay. I'm a big believer of market-related investments when you're talking about stocks and bonds. These are supposed to be passively managed funds. You don't need to have an expensive money manager watching over these things. If anything, maybe you need to pay someone a one-time fee where they basically show you exactly how to get those funds, what funds to buy, and what percentage allocation based on your risk tolerance that you're willing to take to basically automatically have those funds. Because a lot of times when you're using apps like Fidelity or Charles Schwab, they have automatic reinvesting. So what they could do, if you're talking to someone that just charges a consulting fee, they could basically set up all those things for you and automate all of your investments, so you don't really have to think about one side getting or one part of your portfolio getting more risky than the other, and only meet up with that person when you decide to change your financial goals. Because a lot of times these investments can be made on autopilot. You could be investing for 10 years and not change the strategy, and you'll be well off just not doing that. Like, a lot of times, simple investing is about just having a strategy, sticking to it, and not changing it too much. The more you change it, the more you're gonna mess up with the growth of the overall portfolio and everything. You want to have a strategy and stick with it, and make sure you believe in it and understand it. If you're gonna use a strategy like this, I would say it either makes the most sense to have this strategy by max funding a Roth account, or you could have a regular brokerage account. And if you have a regular brokerage account, you don't want to have rebalancing in, because you're gonna have to pay unnecessary capital gains tax. So that's one thing you might want to pay attention to, because as you sell assets at higher prices, you're gonna get charged a certain amount based on what you got in value for that and what you sold it for. Right now, there's no tax on unrealized capital gains. So making sure that if you have a regular brokerage account, it's not really a good idea to use rebalancing, because you're gonna be paying unnecessary tax on it. I would avoid traditional 401ks and IRAs. If your employer is matching and they don't have a Roth option, obviously that's a good idea to take just that match if you plan on staying for that employer long term. But the reason why I would avoid traditional 401ks and IRAs is because who knows what taxes are going to be in the future. If taxes are 50-60%, it might even make more sense to have a brokerage account where you could qualify for long-term capital gains tax and only pay like 15 or 20% taxes, versus paying full income tax on your money in a 401k or IRA where taxes can change to 50-60% at the top marginal rate. So for me, I don't think it's a good idea to really use traditional 401k and IRA accounts. I think right now, based on today's economy, there's other things that you could do to invest, and even putting your money in a regular brokerage account and just investing periodically in it gives you more flexibility and still gives you tax benefits. So for me, I would just avoid traditional 401k and IRA accounts if I have the option to. So for the long term, putting money into this to grow your portfolio over time, it's a pretty solid idea. And as always, if you found some value in this video, go ahead, like, comment, subscribe. If you want to comment on some of the things I said, make sure you leave a comment below and feel free to ask me a question. I have a description to my website below, so feel free to contact me there or leave a comment to ask a question. Thank you.